March 2026, a month that will be remembered as a pivotal turning point for the global economy and the stability of international markets. The financial district is on edge. Across every monitor, the story is the same. The Dow, S&P 500, and Nasdaq are plummeting. Data reveals a disturbing trend. The Shiller PE ratio has reached historic highs, mirroring the heights seen before the most famous market bubbles. Investors are asking if this is just a correction or the beginning of a larger collapse. The data points toward a profound shift in confidence. The trigger for this alarm: a series of bold geopolitical demands that have fundamentally altered the landscape of the Middle East. Recent demands for unconditional surrender in regional conflicts have sent shockwaves through the global diplomatic corps and, more importantly, the energy markets. Supply chains are tightening. The threat to shipping lanes in the Strait of Hormuz has moved from a possibility to a localized reality. Oil prices have reacted violently, surging toward $150 a barrel. This spike is already being felt at every level of the economy. Major regional producers are now citing force majeure, threatening to halt exports and leaving global logistics in a state of chaos. Domestically, the nation is divided. Approval ratings hover around 52%, reflecting a public that is deeply split on the administration's direction. But as inflation climbs, the cost of these policies is becoming clearer. The American consumer has become the final taxpayer for every new tariff. Historical data offers a grim warning. Whenever GDP contracts by more than 2%, the S&P 500 historically faces a prolonged downturn. The administration's trade policies are intended to bolster domestic industry, but the short-term impact on retail and logistics is undeniable. Experts are debating the next move. Is this a healthy correction needed to cool an overheated market, or the first stage of a crash? For the individual investor, strategy is key. Diversification and a focus on historical recovery patterns are the primary tools for survival. The economic whirlwind of 2026 is far from over. Its footprint will be felt in the global financial landscape for years to come. As we navigate these volatile times, staying informed is the only way to safeguard your future against the coming storm. Of course, past performance is never a guarantee of future results, but investors would be foolish to dismiss this warning. Rich valuations alone are unlikely to cause a market downturn, but a correction is certainly possible when rich valuations are combined with a somewhat sluggish economy, a weak jobs market, and rising oil prices. Does that mean you should sell your stocks? Absolutely not. Attempting to time the market can lead to missed opportunities. Continue to hold the stocks whose earnings you believe will be materially higher 5 years from now, but be prudent when putting money into the market. Don't buy any stocks that feel uncomfortable holding through a downturn, and only buy stocks that trade at reasonable valuations. Please like and subscribe, and we will be sharing more videos with some financial advisors in this critical time.